It seems like every day there's a new scandal, and the frequency of these scandals is causing people to rapidly lose confidence in the powers that be. We've uncovered what we believe to be the biggest scandal yet, a revelation that will shake your confidence in what's real and not real in the financial world. Central banks and governments are working in tandem to create something from absolutely nothing. Could this be the ultimate magic trick on an unsuspecting public? Magic is an art that entertains audiences by staging illusions of seemingly impossible feats using natural means. In this report, we're going to explore the art of illusion and the role it plays in our financial markets. One of the most famous illusions was the Trojan horse. The level of ingenuity that was used to produce this deception was so significant that the term has now come to mean any trick or stratagem that causes a target to unwittingly invite a foe in, only to have the illusion of safety replaced by panic and chaos. This report will illustrate how the almighty Dow Jones average is just another Trojan horse and may well go down as the greatest illusion of all time. Creating an illusion on the scale of the original Trojan horse requires a lot of money. Since 2008, we've printed $2,400 billion. That's a staggering sum by any measure. So why was it done? The Dow was at a market low of 6,626 right around the time the Fed started printing all this money. We were told that we need to stimulate and bail out the economy, or the entire economic system would collapse. So print we did. And now look at the market. It's over 15,000. Who knew the stock market would rise if we flooded the system with money? They did. The real question should be, is the Dow really up? Or is it all an illusion? Let's look at how the Dow Jones has performed if we priced it in gold instead of dollars. The Dow-Gold ratio is created by taking the Dow Jones Industrial Average in dollars and dividing it by the price of gold in dollars. This effectively cancels out the dollars, leaving what amounts to the Dow Jones Industrial Average priced in gold ounces rather than paper currency. Why would we want to do this? Well, for one thing, we know how much new gold is mined every year, and so we know how much inflation is happening, which by comparison to the dollar is low enough for us to ignore. Paper currencies are inflated at a much higher rate, and this inflation causes dislocations in the market. These dislocations in the market must eventually be corrected. And this is what we can see quite clearly when we price the general markets, in this case the Dow Index, in gold. Analyzing the Dow-Gold ratio over the long term makes it easy to see that the current hump or cycle looks much more like the cycle that occurred from about 1921 to about 1933 than it does the cycle that occurred in the 60s and 70s. One explanation for this might have to do with the way the Fed controlled the money supply at the time. Up until 1973, the price of gold was fixed in terms of dollars. In other words, a foreign country could return dollars to the U.S. in exchange for gold at a fixed ratio. When a country inflates its money supply while still on a gold standard, it begins the process of losing all of its gold. So in 1973, the gold exchange standard was abandoned and the gold price was free to adjust to economic changes. During the 1921-1933 cycle, gold was also fixed, and it remained so for the entire cycle. The Dow Index, therefore, took the brunt of the correction, since the price of gold could not change. In the current cycle, there is no gold standard or gold exchange standard, and the price of gold moves relatively freely. The Dow-Gold ratio has hit 2 previous cycle lows and 3 previous cycle highs. In September 1929, it hit a high of $18.48, followed by a low of $1.91 in February 1933. The next high occurred in February 1966 at $28.33, with a following low of $1.05 in January of 1980. Pricing the Dow in gold shows us a true reflection of what the market is really doing versus inflation. The inflation that we're seeing from the massive printing of dollars. Looking at the chart, you'll notice the median value is around 5, roughly every 40 years. They say that history repeats itself. We're sitting around 10 right now, but we know we're on our way to 5 and below. Why? Because we simply cannot stop printing money. Everyone knows the Fed's quantitative easing program calls for them to buy $85 billion worth of bonds and mortgage-backed securities each and every month. To put this figure in perspective, $85 billion is double the annual profits of ExxonMobil. It's also equivalent to all the money Chinese tourists spent overseas on holidays last year. It's also just over $1 trillion annually, which coincidentally is the headline budget deficit that the U.S. federal government squanders each year. And the connection between printing money and market performance is clear. With so much money being pumped into the market, stock investors should all have busts of Ben Bernanke next to their trading screens. With few exceptions, analysis, street smarts, and fundamentals have practically been thrown out the window in favor of a tiny banking elite's control over the print button for dollars. Still, it's beginning to look like we may have entered a new phase. Institutional investors are beginning to look ahead and worry what will happen when all that money stops being pumped into the market. It may be 6 months away. It may be 18 months away. Only Ben Bernanke knows. But while the markets have short memories looking back, they do tend to discount future events 12 to 18 months ahead of time. And that's beginning to happen. We're already seeing many stock markets coming off their highs. Many emerging market currencies have been struggling lately. Even the Australian dollar, New Zealand dollar, and Canadian dollar have been weak. All of this indicates that the leveraged investing herd seems to be squaring positions, going to cash, and paying back some of the U.S. dollar-denominated debt they've borrowed. So far, it's all been an orderly move lower, and herein lies the trouble. Few investors are spooked right now because there's so much calm in the markets. But that calm can quickly turn into anxiety, which can quickly turn into panic. It's taken years since 2008 to print so much money. This means that a market panic will unwind years' worth of liquidity in a matter of weeks. It's a financial explosion that no investor should underestimate. Regardless of the time frame, it's only a matter of time until we see the value of our money disappear. If it's not through a financial meltdown, then it will be through inflation eroding your purchasing power away. The Fed has a goal to devalue our dollar by 33% over the next 20 years. That means 2% more money each year for 20 years, leading us to a 50% increase in printed money. What should we call our dollar then? Toilet paper? That's why it's time to buy insurance on your wealth. You wouldn't drive your car without insurance. Why would you not acquire insurance to protect your wealth? Especially now when we know what they're doing to our money. So what do? You could start by looking at an asset that does better against inflation than the dollar has. Right now, we have an opportunity to buy gold, not only on a dip, not only on a double dip, but a triple dip. The Fed is printing money at an alarming pace, and things are not getting any better. Ask yourself, are you better off today than 5 years ago? Think about the people you know living paycheck to paycheck. Think about the people you know who aren't making it paycheck to paycheck. Don't be the citizens of Troy any longer. Whether you're looking for protection, privacy, or profit, we have your answer. Call us, email us, or walk into the office, and our trained staff will show you a plan of action to accomplish what's important to you.